Good afternoon. My name is Kim Schoenholtz, and I'm delighted to welcome you to today's program, which is sponsored by the Stern Center for Global Economy and Business. The center serves NYU through outreach to the broader community, including the academic, business, and policy worlds. We will begin today's fireside chat with introductory remarks of about 10 minutes by Dr. Gopinath, followed by audience Q&A. The session will finish by 6:15 p.m. For the Q&A portion, please enter your questions through the Q&A mechanism in Zoom. Since we've already received many questions from students and faculty, I will limit repetition by grouping similar questions together. Please note that anonymous questions are not permitted. Let me now briefly introduce our distinguished guest. Dr. Gita Gopinath is the Economic Counselor and Director of the Research Department at the International Monetary Fund. She is on leave from Harvard University's Economics Department, which she joined in 2005, and is currently the John Zwastra Professor of International Studies and of Economics. Dr. Gopinath's research focuses on international finance and macroeconomics. She has published numerous articles in top journals on exchange rates, trade and investment, economic and financial crises, monetary policy, and debt. She is the co-editor of the Handbook of International Economics and has served as co-editor of the American Economic Review and managing editor of the Review of Economic Studies. Previously, Dr. Gopinath served on the Economic Advisory Panel of the Federal Reserve Bank of New York and as the economic advisor to the Chief Minister of Kerala State in India. She also was a member of the Eminent Persons Advisory Group on G20 matters for India's Ministry of Finance. Dr. Gopinath is an elected fellow of the American Academy of Arts and Sciences and of the Econometric Society. Last year, the global magazine Foreign Policy named her one of the top global thinkers. In 2014, the IMF designated Dr. Gopinath as one of the top 25 economists under the age of 45. In 2019, the Indian government awarded her the highest honor conferred on overseas Indians. Dr. Gopinath received her PhD in economics from Princeton University in 2001. I know you will join me now, at least virtually, in warmly welcoming Dr. Gopinath to Stern. Dr. Gopinath, the floor is yours.
Thank you, Kim. Thank you so much for the kind introduction. And it's really a pleasure to do this. And also welcome to everyone who is joining this webinar. So what I'm going to do right now is I'm going to share my screen and walk you through a few slides. Okay, so I assume everybody can see this. So what you see here is what I'm going to show you is kind of a very bird's eye view of the economic landscape during these incredibly challenging times. So it's been now, depending on how you date it, it's about 7 to 8 months since the start of this pandemic-driven crisis. And in April itself, it was quite clear to us that this was going to be the worst crisis since the Great Depression, a truly global crisis. And in October, just a couple of weeks ago, we put out updated numbers for the global economy in terms of the size of the collapse that we are projecting for 2020 and 21. So what you can see here on the left graph is firstly, you have the blue line, which is the path of the global economy that was projected before COVID. And all the other lines are the path that's been projected after COVID with different iterations of our projections. So the most recent iteration is the one in October. That's the black dashed line, according to which the global growth will be negative 4.4% in 2020. And then there will be a rebound in growth in 2021. But as you can see, we're not getting anywhere close to pre-pandemic projected paths. Importantly, there are numerous risks still at the horizon. We still don't have a solution to the health crisis. There could be further, we are seeing resurgences of the viruses in different parts of the world. It's not just second waves, but third waves. Financial conditions in such situations where right now fairly tranquil, I would say, could change dramatically. You could have escalations in geopolitical tensions. So these are all the downside risks. Now, of course, on the upside, you could get much better news on therapies and vaccines and greater policy support, and all of that could improve the outlook. So just very quickly in terms of what's needed, I mean, given that this is first and foremost a health crisis, policy support is needed in that sector, in the matter of health. And globally, what's really needed is a collaborative effort to make sure that any treatments or vaccines or better testing procedures that are developed are made globally available. I mean, that has to be a huge priority. I mean, ensuring the soundness of the financial system is very important. And it's also very much the case that there are countries that just don't have the finances to deal with this kind of a crisis, and international support will be needed. So here's just a picture to tell you a bit of a story. What you're seeing on the left graph is the number of COVID cases. As you can see, you're seeing second and third waves and rising numbers. And so there's no lack of contagion at this point. What you're seeing in the middle graph is, though, that we've learned to live better with the virus. There is also better medical solutions, and the demographics of who's being affected has changed. So we're nowhere seeing anything like the level of deaths that we saw in the spring. But because of the resurgence of the virus, you have had a stalling of reopenings of economies. And in fact, you've actually seen some reversals in many parts of the world, and mobility has also slowed down. So this is why we describe the return back from this pandemic-driven crisis, what we call the Great Lockdown, is going to be long, because as long as we still have the health crisis to deal with, it's going to subdue economic activity, especially in contact-intensive sectors. And so you see kind of the uneven recovery that we have here. Let's just focus on the middle and the right graph. You've seen improvements in manufacturing. This is the Purchasing Managers Index. It's the survey of those in the manufacturing sector. And you see that manufacturing continues to improve between August and September. There's been an improvement, more dots above the 45-degree line than below it. But on the other hand, when you look at services sector, you are seeing weaknesses, and you're seeing actually signs of even a reversal in service sector recoveries. Similarly, there is unevenness in terms of recoveries when it comes to stronger recoveries in business sentiment than in consumer sentiment. And in terms of trade, you've seen a quicker rebound in goods trade, as opposed to in services trade, which includes tourism and travel, which remains depressed. So what that means basically, which is what you have on the left graph here, is that countries that rely more heavily on travel and tourism for their source of income are getting harder hit. They were just much more harder hit in the first half of this year. What the middle graph also shows you is that countries where the lockdowns were more stringent had bigger hits to their GDP. Now, of course, this is a correlation, not a causation argument. And so we actually have analytical work that's going into the role that's played by lockdowns versus voluntary social distancing. And what you can see is, what we find is that it's about 50-50, which is about, yes, lockdowns have an independent effect on economic activity, but voluntary social distancing also plays a very important role. So again, just reopening economies by mandate will not bring back a full recovery, because you have, you still have the virus that people, because of which people will stay home. Now, labor market conditions also, which plummeted in the peak of this crisis, which was in March and April, have reversed. If you look at total employment, if you look labor force participation, but we're still looking at numbers that are still well below pre-COVID levels. So, these are difficult times for jobs and labor market and for jobs. And also there's been a lot of polarization in the labor market. So if you look at who has been harder hit during this crisis, you can see, for instance, in the left graph, that the unemployment rate has gone up by more for those with lower levels of education as compared to those with advanced degrees. Not surprisingly, because they tend to work in sectors that are much more contact intensive, which are getting harder hit, as opposed to work that can be done remotely. The second picture, the middle graph, what it shows you is that this is also leading to polarization in the form of women being more affected than men. In this particular graph, what you see is that when you had announcements of stay-at-home orders, and particularly school closures, women were more hit, because it's still very much the case that women tend to be the main child caregivers at home. The right graph shows you something we're all very worried about, which is coming out of this crisis, where will jobs come from? Sectors like leisure and hospitality that were very hard hit by this crisis had a large number of jobs that were lost. But if you look at sectors like e-commerce and warehousing, which have, if anything, benefited by this during this crisis, there's been job creation that's come about, but you've seen employment come about, but there hasn't been that much of it to offset anywhere near the kinds of employment losses that you saw in the more contact intensive sectors. A big concern for many people coming up with this crisis was that, would this be inflationary, or would it be deflationary or disinflationary? What you certainly are seeing as of now, at least, is that in many parts of the world, it is actually keeping core CPI inflation low as opposed to too high. So it's actually drifting down. If you look at the core CPI in emerging markets or in advanced economies, you can see that drifting down. And some of that has to do with what you see with commodity prices, especially oil. The drop in oil prices, the recovery, but still well below pre-pandemic levels. Now, what has been a silver lining is the very large policy response that's come about from this crisis. You've seen very large amounts of monetary easing by central banks, asset purchases by central banks, liquidity injections, and because of which, despite having a very large collapse in the real economy, there is no financial crisis at this point. And that has benefited not just, individual economies, but the global economy as a whole. Emerging markets, which had seen big reversals in capital inflows, are seeing more stability. And in some places, you have a return. But again, it's quite heterogeneous, because there are some emerging markets that were in good standing, that were considered investment grade, where they're able to borrow at very low rates and low spreads. But then there are non-investment grade emerging markets, frontier markets, where these spreads are still well above pre-pandemic levels. And of course, there are emerging developing economies that will have to deal with very large currency fluctuations. Fiscal measures have been, again, unprecedented and large. We're looking at around $12 trillion in fiscal spending. But again, most of that has happened in the advanced economies, which is what the left graph shows you, which is about 20% of their GDP, while it's about 6% in emerging markets and about 2% in low-income countries. So very disproportionately in advanced economies. The right graph shows you that this difficult situation that policymakers are in now, which is that despite the fact that there's been many months into the crisis, we're still having resurgences of viruses, there are still lockdowns happening. And so while some have been able to extend policy support, others have not. So there are policy cliffs. And one important point we are making is to tell policymakers that have the fiscal space not to prematurely withdraw their support. So what does this all imply? And I'm going to stop in another couple of minutes, but what does this imply in terms of the path of the global economy going forward. So this graph shows you that. It basically plots the path of real GDP for the different parts of the global economy over time until the end of 2021. What you can see there is the red line, which is China. China has been quite the outlier. It is recovering very quickly to pre-pandemic levels. If there was ever a classic V shape, this would be it. But on the other hand, if you take advanced economies as a whole or emerging and developing economies, excluding China, this is a much slower recovery. Most economies are not returning to 2019 levels, even by end 2021. And overall, emerging and developing economies, excluding China, are having a bigger hit to their per capita incomes by the end of this, as opposed to advanced economies. So there is growing divergence in the global landscape. And there's going to be a very large significant scarring effects coming from this crisis. Overall, between now and 2025, while incomes will go up, they will go up by significantly less than what was projected pre-COVID, which means a big hit to living standards everywhere. Again, like I said, there still remain risks on the horizon. There could be upside risks with better news, especially in terms of dealing with health crisis, but there could also be serious downside risks. For instance, if you look at bankruptcy filings, they've stayed quite low, despite this being such a severe crisis because of all the policy support. But if that comes off, you could have an increase in bankruptcies and a much larger increase in jobs lost. You could have financial market turmoil at a time when sovereign debt is at record high levels everywhere. And you can see on the rightmost chart the fact that if you look at, we keep track of countries that are going to be in, say, fiscal distress, are in high or moderate rates of fiscal distress. While it was the case that before this crisis, about 50% of low-income countries were already in medium or high rates of debt distress, now we're also seeing some emerging markets entering that space. And again, investment takes time to recover, so that's going to weigh on the outlook going forward. And the middle graph shows you that, while in all recessions you have a hit to human capital because people aren't able to stay on the job and work, but this time around we have a unique situation where there's loss cooling, which we know has a direct hit to human capital, and that's going to weigh on the potential outlook for the economy. And I'm going to end with the graph on the right, which shows you that for the first time since 1990, we are seeing a reversal in the gains in poverty, which is that there's going to be a projected increase in extreme poverty with up to 90 million people entering extreme poverty just in 2020. So there are many challenges ahead. We're not out of the woods. A lot has been done, but a lot more will be needed. So let me just stop with that.
Thank you very much, Dr. Gopinath. That was a wonderful tour d'horizon of, unfortunately, what we face ahead. And I guess I'd like to just start by focusing on COVID and the outlook, so spend a few minutes doing that. So you talked about scarring, long-term scarring, and I'm wondering if you could go a little bit further into what the causes of scarring are. You mentioned human capital accumulation. You mentioned the possibility of bankruptcies. But I'm wondering, in addition, whether you could also fill us in about where scarring is probably the greatest risk, advanced economies, emerging economies, et cetera.
Yes. So scarring shows up in many different places. One is for instance, in the labor market. We do know that when people are out of jobs for a while, it has an effect on their human capital. We know, unfortunately, the young people who enter the job market in bad times have a big hit to their lifetime income prospects. And I'm not saying that that's going to be true of those listening today, but there is a risk associated with it. And if you just look again in terms of the loss cooling and the effect of that on human capital, that affects productivity, and that's an important part of your future potential for your economy. So that's one piece. Second, of course, what matters for the future is also the amount of capital that's going to be there in terms of physical capital. And that depends on the amount of investment that's being done today. But when you're living in a time with very high levels of uncertainty, and you have a situation where firms have borrowed very heavily, they could be in debt, in distress, they could have balance sheet distress. All of that could weigh on investment going forward, and that's another source of scarring. Which countries are going to be more affected? Now, firstly, there are countries in the world that rely on, like 50% of their economies rely on hospitality, tourism, travel. There are economies that are major exporters of oil. They depend. I'm sorry, my phone just disconnected, but let me.
We can hear you.
Yep. So those kinds of economies, for them, the impact is large, and it's also a whole, there's a whole concern about where will their growth come from. Then there are economies where they don't have the fiscal space to kind of prevent too many jobs from being destroyed, to prevent too much of destruction of human and physical human capital, particularly, and that also has large scarring effects. And we're going to come out of this crisis with very high record levels of debt for economies, high levels of inequality and poverty. So these are all going to be legacies of this crisis.
Thank you. You talked about the Great Lockdown, and you pointed out that the lockdowns themselves accounted for a significant portion of the effect on the economy, but also the endogenous response of households not wanting to travel or acquire services that require contact. All of that matters as well. I think you suggested the effect was 50-50 roughly in the fund's research. But have we learned how to better employ various kinds of public health tools? Have we learned lessons from the enormously varied experience of different countries in the earlier part of this year that we can apply going forward?
Absolutely. I think in the start of the crisis, the reaction was to go big. And so you had national lockdowns that happened in many parts of the world. What's been learned in the last several months is that there are other ways of coping with it, which is to have much more targeted lockdowns, do much more extensive testing, tracing, using micro measures like wearing masks and hygiene and maintaining social distance. All of that can actually be quite effective in controlling the spread, and so that you don't have to shut down all economies, right? You have to want to do this in a much more targeted way. So countries that rely more heavily on these kinds of non-pharma interventions, I guess, these would be the ones that have been able to control the spread of the virus. And again, the dust hasn't settled on this and what's the most effective way to deal with it. Every country is going to be different, because in some there is already the culture. For instance, in Japan, there was already the culture of wearing masks in the winter or in certain periods of time, and it came very naturally for them to do it. In other parts, it wasn't. In some places, social distancing happens pretty automatically. In others, it's just impossible. In places which have high densities of population, that's much harder to do. But I think what's quite well understood at this point is that going for draconian lockdowns across the board has big costs for the economy. Doing much more targeted measures along with testing and tracing has some good benefits.
Thank you. You highlighted one of the great tragedies of this episode, and that is the fact that we're seeing a very sizable pickup in outright poverty for the first time in something like 30 years. What can and should be done on the part of advanced economies or the International Monetary Fund to address that disaster?
Oh yes, this is a major concern, and this is happening in countries that don't necessarily have the finances to deal with it. So I think the number one need will be for countries to receive financing. That would take the form mostly in the form of concessional aid and grants, so that they can, so as to make sure that these countries are able to provide basic livelihoods to everybody. So this is something that we've also done at the IMF. We provided emergency financing to around 75 plus countries, who've then been able to use that money to make sure that there's essential healthcare provided, basic income for the poor, to ensure livelihoods. Now, of course, this is just the beginning of the solution. More is going to be needed. It's the poorer families that are more being hit in terms of jobs. They're being hit in terms of, schooling. I mean, distance learning is possible when you have good infrastructure and you have, internet access. Half of the world doesn't have internet access, and you can't really do distance learning. So remedial measures will be needed for the next several years. I think a lesson to be learned from this crisis is the importance of having strong social safety nets. If you're able to get to most vulnerable people as quickly as possible, you just have a better time in preventing deep economic distress. And hope is coming out of this crisis. Countries will invest in that.
Okay. You mentioned a number of risks to the outlook, several on the downside, some on the upside. And I'm just listing a few: financial conditions deteriorating, trade tensions rising. And obviously on the upside, but perhaps a speedier development of therapies and their distribution. Could you explore that a little bit more, risks on the positive and negative side?
So yes, given that this is first and foremost a health crisis, the gains from actually having a quicker end to it is just tremendous. So for instance, we have that, we did a simulation where we said, what would be the scenario if there was enough investment to make sure that effective treatments and vaccines and even tests were globally available, much sooner than what we have in our baseline, and also truly globally available, as opposed to some countries getting it much sooner than others. And if we have that can add up to $9 trillion between now and 2025 to the global economy. And it benefits both advanced economies and developing countries, because the world is just better off when everybody is better off, in terms of just the benefits you get from international trade, but also you can end the pandemic finally when it ends everywhere. So there are huge gains from it. I mean, $9 trillion is a very large amount of money, and you can see that the cost of doing this is just minuscule in comparison to this gain. In terms of other risks, of course, the financial markets is an important one. Again, financial markets, like I said, are in a much better place than the real economy is. There's concerns of financial real economy disconnect, and so but if it turns out that, for instance, the resurgence in viruses that we're seeing now brings in a really bad set of takes a much bigger hit to economic activity. If the news on vaccines or treatments are just not as great as one was hoping for, then you could see this kind of the optimism in the financial markets changing very quickly. And because many economies have relied on borrowing to deal with this crisis, they have elevated debt levels, and that could trigger debt distress, not just countries, but corporates, and in some cases, households. So that's another major concern that we have. And lastly, again, what I do worry about is economies where, that might have to go through structural transformation, which is economies, like I said, that depended very heavily on tourism and hospitality, oil exporters, that they're going to have to accelerate that transformation. And there are obviously severe risks associated with that too.
With regard to trade tensions, in the past 100 years, we've observed periods when economies weaken and protectionism surges. We've already had some threat of deglobalization in recent years. How serious is that risk?
So yes, there were, coming into this crisis itself, there was a move towards greater protectionism. You saw in terms of the number of measures being put on trade, in terms of tariffs, in terms of restrictions on investment coming into countries. We've seen those increase over time, and that has had an effect. But to be clear, if we look at the collapse in trade that we've had, so we're projecting for 2020, global trade falls by around 10% and then recovers in 2021. That's been fairly in line with the collapse in global demand that you see. So there's not any, there hasn't been a very dramatic amplification that came from just a breakdown in trade relations. But again, like you said, difficult times sometimes makes often, I guess, makes countries turn more protectionist. And that would be a real problem for the recovery, because we know that global trade helps keep productivity high and will strengthen the recovery. And so it's very important for countries really not to start going inwards and to continue to maintain their trade relations.
So let me just try and sum up the COVID-related questions with perhaps a more pointed one. Is there a trade-off between efforts to improve public health and efforts to stimulate recovery?
Okay, this is obviously the million-dollar question, and I would say that we will know the answer really well when we've had a lot more data and many more months of it. But an important thing to keep in mind, so I'm not going to give you a simple yes and no, but I'm going to make the following arguments, which is that, firstly, we know from our analysis that it's not just mandated lockdowns, but it's also what people do voluntarily. And so if you aren't able to bring down the contagion, if you aren't able to contain the spread of the virus, then people, regardless, will hold back in their activities. Not everybody, but a lot will, and especially certain kinds of activities which are non-essential activities, and we have seen that happen. And we also know that lockdowns, especially done in a particular way, as we describe in the analytical work, has helped with reducing contagion. And so, in that sense, the lockdowns, while having an effect on economic activity now, indirectly reducing economic activity because they were able to contain, in some sense, the health crisis, they also gave greater confidence to people to engage back in economic activity. And I think we're going to have to wait and see the trade-offs, not just now, but also the trade-offs over time, to see whether we end up with lesser scarring because of these measures or despite these measures. And so, we need to do a lot more over here. But in terms of the trade-off, I think the point has to be that as long as there is the risk of infection, it's very hard to get a full recovery.
Thank you. Let's turn to policy a little bit more specifically. As you stated, public debt levels are rising around the world. And I'm just wondering what the risks are arising from that and what constraints this will have on both fiscal and monetary policy in the future.
So yes, the fact is that public debt levels in advanced economies and emerging markets are at record highs. The highest they've ever been. For the global economy as a whole, that number is now crosses 100% of global GDP. So the question is, what does that then imply for the future? Here, of course, we have to make the distinction between countries. There are many advanced economies that are able to borrow at incredibly low rates, even negative rates, and at long maturities, which means that debt servicing costs will be low. And given our baseline projection of growth returning in 2021, what we expect will happen for many economies is that debt to GDP ratios will stabilize and gradually over time start coming down. Now, There are, on the other hand, there are economies whose debt levels are already unsustainable. They have high levels of, it's already too high. And for them, I think the important solution is to have debt restructuring and to do it as soon as possible so that you can free up resources to deal with this crisis. Then there are some others for whom the debt to stress is not that large at this point, but debt servicing costs are high. And for them, giving debt service relief is going to be important, but also access to international financing on concessional terms for multilateral institutions can also play an important role in dealing with it. So to the question of how bad of a problem does this debt create in terms of implications for fiscal and monetary policy, again, if the baseline holds and growth starts coming back up, we should see for most countries that there would be a gradual reduction in debt to GDP over time. So that should, with enough of a runway, that should give economies time to use the fiscal and monetary policy tools to do their macro stabilization.
So when you talk about debt restructuring, are you thinking of private market restructuring, or are you thinking of a role for multilateral institutions like the fund in providing debt relief?
So when you talk about restructuring, we do think that all players will need to be involved. I would say official bilateral creditors and the private sector would need to be involved in providing debt relief. At the IMF, for instance, we have provided debt service relief to our poorest members who owe debt to the IMF. We've given them, it's a 12-month relief. You have the Debt Service Suspension Initiative, which is a G20 initiative, which is more about, a moratorium on debt payments for about a year. But more will be needed. And so far, the private sector has not been involved. But in some cases, in some countries, I think it's important, just for the fairness purposes, that it applies broadly, not just to the official sectors.
So the IMF has been involved in debt restructuring and debt relief in the past. How do the current efforts compare to what the fund has done in the past?
Well, so firstly, again, a remarkable feature of this crisis is that, you can still get market financing for many countries in the world. So there is, the problems that came up during the global financial crisis, which was truly a financial crisis, is not what we're seeing right now. Mm-hmm. So many economies have access at very favorable terms, and they can borrow on the market. But of course, yes, there are countries that have individual economies that have high levels of debt and debt to stress, and they've had restructurings. You saw the recent case of Argentina, in which we were also, we've been involved with Argentina for a while now. But an important measure that we are taking right now, because we are concerned about a situation that there could be, we don't wish for it, absolutely, we would like to avoid it at all costs, but there could be a situation where there is more wider debt to stress and more wider restructurings that might be needed. And we are working on building a new international debt architecture, kind of a common framework that can be used so that we can have much more speedy resolutions of these kinds of these restructurings, and including all players as opposed to, only one set of players.
So, as you mentioned, quite a number of countries can borrow at extraordinarily low cost today, and implicitly the financial markets are suggesting they have fiscal space. So, how should they best use it? What's the way to in countries that do have fiscal space, what's the kind of how should they use it to actually improve the outlook?
So countries that have fiscal space where, because of the pandemic, you still have sectors or cities that are locked down, we've made the case that they should be providing income support to households and also helping firms, supporting firms And that's been done. That's been done in many parts of the world, including the US and in Europe. And to continue to do that for the next several months, as long as we're still with this pandemic. A second important point we make is that this is the time, if ever there was a time to do a public investment push, this would be it. Public infrastructure, if you were looking at high quality public infrastructure investment, investing in a green recovery, investing in digital infrastructure, all of that has the potential to not only increase jobs by a large number, increase output, bring back the recovery faster, but also because of the very large positive effect it has on the economy, it can be beneficial also from a fiscal sense because your debt to GDP ratios can go down. Now, of course, this will happen in countries where there is good governance, and in this current environment of very low interest rates and very high uncertainty, which is holding back private sector investment. So again, public infrastructure investment, we think, is an area where fiscal spending can be particularly beneficial.
So to put that a little differently, an increase in infrastructure outlays that raises productivity can actually contribute to a decline in debt ratios over time.
That's right. That's exactly right. Because while, yes, you borrow to spend on that infrastructure, but you get a very large effect on output. And so the ratio of debt to GDP will decline. It makes it easier for you to actually bring down your debt levels, yes.
Okay. So you've written in the past about sovereign defaults, and given the very high level of debt, one would naturally think that defaults are going to be part of the landscape going forward. Do you have any comments on that or suggestions about how the sovereign debt landscape will evolve over the next decade?
So there have been many defaults in the past. Defaults in the past have tended to be typically quite messy. It takes usually around 7 years to get a debt restructuring done. Often you have multiple rounds of debt restructuring because the first round is not enough. So it is not a smooth process. Sovereign debt restructuring is definitely not a smooth process. So what we're trying to do with this new work is exactly to deal with that, which is to kind of make it a much more smoother process going forward. Now, again, to be clear, I mean, countries benefit a lot from receiving capital flows. Individual economies care a lot about having access to markets. So you certainly don't want a situation of very disruptive debt restructuring and defaults happening everywhere. So one has to deal with this with care. You don't want to spook markets and have panic withdrawal of capital from economies. But at the same time, this is a crisis like no other. Countries have been hit by a shock that was not something they self-generated. It's just a truly kind of exogenous shock if ever there was one. And if they're going to be saddled with incredibly high levels of debt that they can't pay off, then there's no incentive to invest. And that's just going to worsen prospects for paying off your creditors in the future. So there is a good argument for some countries that will need this kind of debt restructuring for that to happen sooner than later.
Great. You and other researchers at the fund have talked about an integrated policy framework to try, if I understand it, to address volatile capital flows to and from emerging economies or emerging and developing economies. My understanding is that this would involve multiple tools, including potentially monetary policy, capital controls, currency intervention, and the like. Could you explain a bit more about the integrated policy framework that you envision?
Oh, absolutely. So Kim, I mean, if you think of the frameworks that we have, the frameworks that have been built and overbuilt ad infinitum, like the inflation targeting framework, I mean, a lot of those are built on the assumption that you're a country that doesn't really face turbulence in financial markets, at least internationally, or that you're a reserve currency issuer, so your trade and your financing internationally gets done in your own currency. The reality, of course, is many emerging and developing economies trade in international markets. They borrow and they finance themselves in international markets, not in their own currency, but in a foreign currency, very often the dollar. And while they do benefit from capital flows, they also get hit by the turbulence of capital flows. And because of which policymakers in these economies often find themselves not being able to control the relevant lending rates in their economy. So this is what they fear about of losing monetary policy autonomy, even if you have flexible exchange rates. And so if you look at what these countries do, they do use more tools. It's not just standard monetary policy tools and flexible exchange rates, but they do FX intervention, they use capital flow measures, and in addition to macroprudential measures. Now, what's been missing is a framework for how to use these additional instruments in addition to the standard instruments that get used. So the integrated policy framework is exactly that. It looks at how to combine these different instruments in an optimal way to help countries, best stabilize their economies. And these are economies that are dealing not just with their domestic shocks, but also external shocks. If there is monetary policy easing in some in advanced economies, how that can affect their domestic economies. So to shield themselves. So it's basically, it was a gap in the policy literature on how to, or even the academic literature on how to use these different tools in an integrated manner, recognizing that when you use one, it has an implication for other. And that's what the integrated policy framework is.
So just to take you back a moment, because I think you answered it, but just to clarify, why don't flexible exchange rates why aren't they sufficient to provide monetary policy independence in emerging and developing economies?
So, so the classic argument is that if you have flexible exchange rates, then you have, you're able to independently move your policy rate around, and that's it. And then you have all the flexibility that you need. But unfortunately, that's not the way the world works. The way the world works is there are financial intermediaries that intermediate monetary policy with the ultimate borrowers and savers. And these financial markets and these financial intermediaries are less than perfect. You can have changes in appetite for different kinds of risks. You can have, you can have limits to arbitrage. And so in such a situation, even if, technically a monetary authority can control the policy rate that it's announcing and putting on its website, the actual rate at which their borrowers can borrow, firms can borrow, households can borrow, can save in, is affected by what's happening in these financial markets. And so if you don't have very well developed financial markets, you don't have deep financial markets for instance, for your own local currency bonds, then there can be turmoil that comes, which is inherited from outside. And that's when you can lose monetary policy autonomy.
Understood. In the advanced economies, many central banks have now expanded their balance sheets in ways that we have not seen before. And they've driven interest rates down to zero or even lower, as you mentioned. What more can central banks in the advanced world do to promote recovery, or have they reached the limits of their capacity?
The central banks, did incredibly well in preventing a financial catastrophe. So when there were huge disruptions in the markets, breakdowns of arbitrage, the interventions by the central banks around the world and their asset purchases played a very important role in providing liquidity, in calming the markets down, bringing spreads down, and they've been very effective with that. Now, what we are seeing right now, though, is we're looking at a world where the vast majority of economies have policy rates. When I say the vast majority of economies, I mean the ones as a share of GDP. So kind of as a percentage of global GDP, the vast majority have policy rates that are below 1%. So we're getting pretty much close to the zero lower bound everywhere. And dealing with this crisis, it's over time morphing from a liquidity crisis into a solvency crisis. And monetary policy is good for liquidity problems, but not for solvency problems. So I think this is a time for fiscal policy really to be playing the major role. And while a lot has been done, I think a lot more is going to be needed from fiscal policy.
Do you worry that a long episode of near zero interest rates will have unpleasant implications for financial stability?
That's been a major concern. So it was true even before this crisis about the buildup of financial risks. And while there's been great progress made in the banking system and the regulated banking system in ensuring its stability, and you can see the benefits of that. In this crisis, the banking system has continued to provide credit. It's not been an amplifier of the crisis. And so that has worked. The regulation in the past has been absolutely important to prevent a banking crisis. But at the same time, there are the non-regulated sectors. There's corporate borrowing, there is household borrowing, all of which is, where the risks can be building up over time, which is, again, exactly the reason why you don't want to rely that much on monetary policy, but more on fiscal policy. Because if you're using fiscal policy, that's when you can actually see prospects of coming out of the liquidity trap, interest rates coming back up, so that we escape this incredibly low interest rates for very, very long.
Understood. Okay, so just staying with monetary policy for a moment, there has been advocacy that monetary policymakers should do what they can to address income and wealth inequality. I'm wondering how you view that and what you think central banks can do to address income and wealth inequality.
Well, so central bank instruments tend to be relatively blunt in doing something, on a targeted basis. Now, they've been very creative and innovative in this crisis, so they've certainly, come in with many kinds of programs. But in general, monetary policy doesn't, the levers that it can pull, I would not say are meant to address specifically questions of inequality. Now, that said, because if you have a situation where what you did see was because of significant monetary easing that happened even before this crisis, the accommodative stance of monetary policy, you have an improvement in economic activity, and through that you see higher levels of employment, including among those at the low end, right? So, while there is always this complaint that monetary policy just makes the wealthy wealthier because you see asset prices going up. But on the other hand, monetary policy also has a very important role in reducing unemployment rates. And by reducing unemployment rates, the biggest beneficiaries are those at the lower end of the income spectrum, because the high end income spectrum don't really lose their jobs in most situations. But the low end gain from that. So there is a huge benefit in terms of improving income prospects for low-income households that comes about from monetary policy. But otherwise, more generally, the domain of redistributive policies is more in the fiscal space than in the monetary space.
Does the same balance between monetary and fiscal policy also apply to efforts to address climate change?
Yes, this is also going to be a very important topic going forward. I think what certainly, when people say that you want to seize the opportunity even in a crisis, I think people are seeing this as the opportunity to accelerate the green transformation. This is a pandemic, a crisis we couldn't have imagined, and risks from catastrophic climate change are huge. So this is going to be a big area. Now, the question is, how do you do it? I think there's going to be innovation on this front, but to me, again, this has to be more in the fiscal domain than in the monetary policy domain.
And is it feasible for emerging and developing economies to use fiscal policy to address climate change or income and wealth inequality in the way that it might be for advanced economies?
There's no denying that there are, that they are far more constrained in what they can do than the advanced economies can do. We just saw that in terms of the spending that the different parts of the world did in this crisis. So yeah, so there's going to be a limit, but what that means is that policies in developing countries will have to be, more targeted. They might be smaller in scale. They'll have to be more targeted, as opposed to providing blanket support to everybody. You kind of want to target to the poorest in the population. There are many countries that anyway needed to expand their revenue base to be more effective at revenue collection and to cut wasteful spending. Those are measures that need to be accelerated now. I think more true around the world would be the importance of making sure that everybody pays their fair share of taxes to prevent tax evasion, to make sure that corporations are paying taxes somewhere in the world. All of these measures, I think, will become even more important, especially as countries exit this crisis with large amounts of debt.
Great. I'd like to turn to a big picture view of the fund itself. We're now 75 years from the creation of the Bretton Woods institutions, and they've served us quite well in my view. But there are obviously signs of stress. What do you see as the future of multilateral institutions and the global system that they support?
So, first to start with acknowledging, and thank you for what you said, before acknowledging the role that multilateral institutions have played right now. Again, like I said, we have provided financing to 81 countries in this crisis. We provided debt service relief to our poorest members. We're providing aid to some countries at literally zero interest rates. So that kind of multilateralism backed by our 190 member countries is very important for dealing with this crisis. The G20 debt service suspension initiative has also been important. But that said, I think a lot more is needed. We still have the fact that we cannot guarantee that there will be enough production of successful vaccines or treatments to make sure that everybody gets it, at relatively the same amount of time, same point in time. And we know the great benefits from having that collaboration happen, but that's not the case. We do worry about, the rise in protectionism that can come about. There were restrictions that were put on medical exports that could come back up once there are again vaccines and treatments developed. So there is a lot more that needs to be done. The problems the world faces just requires greater global cooperation.
So the IMF has a role in the quality in influencing the quality of macroeconomic data that is produced by member countries. I'm wondering if you could describe that and where we're headed in that effort to try and make sure that what countries report is both reliable and accurate.
Well, that's an ongoing effort. It's what we do all the time. We have, we engage with countries. We do look at our own data and analysis, and raise, if there are concerns to be raised, we do that. So that's something we continue to push on. I suspect the issue of data is going to become more complicated in the future, especially if we move towards more, which is what everybody expects, to more digitalization, a great digital economy, more e-commerce. We know that those already pose significant challenges in terms of measuring prices and measuring inflation, measuring the economic level of economic activity. That process has been accelerated. So we've been working on that too, in terms of thinking about how do you do measurement in this kind of digital economy? And that's a project we've been working on for some time now. But again, these are the kinds of questions that we grapple with, and our statistics department spends a lot of time on it. I must confess that I know less about it than the statistics department does.
You've written about the dominant currencies, and for example, about the role of the dollar as a trade invoicing currency. I'm wondering if you could talk about that a bit, but in the context of addressing what are the costs and benefits of having a reserve currency to begin with?
What the costs and benefits of
having a reserve
for the country itself, who is the reserve currency issuer, or for the world, or for?
Well, for the global system.
For the global system. So firstly, whether you like it or not, it's always been the case that there has been one currency that tends to dominate the international monetary system. It was the British pound before the dollar. And then it's been the dollar in the last 70 plus years or so. What does it mean to dominate the international monetary system? It means that the dollar gets used heavily in international trade in transactions where the US is on neither side. So it's neither the importer nor the exporter, but people are trading with each other in dollar terms. So the ratio is about 4-1, which is 40% of global trade gets done in dollar terms, while the US share of global trade is only around 10%. And this is despite the fact that the U.S. economy share in global economy has, declined over time as emerging markets have gained market share. So that's one thing. Secondly, the dollar is predominantly the currency in which central banks hold reserves, right? Foreign reserves, as opposed to the euro or any of the other currencies. 60% of international reserves are held in dollar terms. And third, a lot of cross-border borrowing and lending is done in dollar terms, again, even though the US is not on either side of that transaction. So that's what it means. And like I said, that's historically how it's been. It's always been tended to be a currency that dominates. Now, of course, what that does mean is that, the country that is the reserve currency issuer does have the benefit of, because it's a safe asset, it's able to borrow it incredibly low interest rates, because most of its goods are priced it imports from the world are priced in dollars. A weaker currency or a stronger dollar doesn't have much of an effect on US inflation, which is not the case for other parts of the world, where when their currencies weaken, it has an impact, a stronger effect on their inflation. So, the question is, do you think there would be a better world if there were multiple such, quasi-dominant currencies as opposed to a single dominant currency? And actually, I don't think there is a simple answer out there. I would say that you could benefit from having certainly more of some of the other currencies in the world than what we have. So even if one doesn't go to an equilibrium where there are 4 currencies and each gets 25% of the market share, I think you could see a scenario where the euro could have more of a market share, and some of the other currencies that are coming up, the renminbi has more market share. But why might there be some, what could be the issues with having too many such reserve currencies? One problem is that it could actually lead to more financial market turbulence in some sense, because if it turns out that if people are going to shift portfolios across many different kinds of reserve currencies all the time, then you can get a lot more financial market turbulence. And you did see that, for instance, somewhere during the, I think it was the interwar years, when you had multiple such dominant currencies.
Okay. So let me just introduce a question that I know has come from many students. Do you have a view about central bank digital currencies?
Oh, yes. So that is, that's certainly being discussed. It's in the working stream of every major central bank, is central bank digital currencies. Now, it has the benefit of, I would say it's not necessarily central bank digital currency, but digital currencies, stable coins, can have the benefit of greater financial inclusion. But at the same time, there can be risks, at least at the international level, associated with it, which is that if there are, for instance, central bank digital currencies from a reserve currency issuer now that's available, the risks of for instance, the dollar becoming then become the currency that gets adopted in developing countries that don't have very strong currencies. The risk of that goes up. So what we call currency substitution, the risk of that can go up. It might be harder to regulate. It might be harder to prevent such kind of currency substitution from happening. So that's an important risk. And secondly, and then of course there is the question of what exactly is the central bank, doing in the sense of, is it actually going to replace the banking system and the intermediation that it does? I think the answer is no. So it should take the form of some kind of a partnership between the central bank and the private sector. But we are moving towards more digitalization everywhere, and I think that all central banks in the world are looking very carefully at the need for a central bank digital currency. There are countries where, for instance, nobody uses cash anymore. That was the argument in Sweden. And so then the question was, what exactly is the monetary liability? And, because nobody's actually holding cash. In that case, again, there is the need to have a central bank digital currency. So again, this is all in the realm of things that are being worked out as we speak.
Okay. There is a question from one of the live question that goes to one of the points you were making earlier. It looks like China is a bit of an outlier compared to the emerging world and compared to many countries in the advanced economies. Can you explain that? What are the reasons why China looks like it's an outlier?
China definitely, looks like an outlier. It is an outlier. In terms of our projections, we have Chinese economy growing between 2020 and 2021 by 10%, while pretty much everywhere else in the world, they are shrinking relative to 2019 levels. So it's a big difference. The sources of the difference: one, China has been very effective in controlling the pandemic. They did it very quickly. They did very strict lockdowns, and they brought down they brought their reproduction rates down very, very sharply, and they've been able to keep it at that. So while there have been resurgences, they've been very effective in doing localized lockdowns. The combination of widespread testing, tracing, all of that has played a very important role. So that, I think, is a very important factor, because of which, China has reopened almost fully. Within their economy, there is hardly any activity that's restricted at this point. So, it's effectively, they almost have no conditions in terms of the size of the gatherings and so on. There are some, but not really small. Second is China has benefited from, gained from exports of, medical equipment, but also equipment that people are now buying because they're working from home. So there's been a big surge in demand for things that China produces at very large scale. And that is, you've seen a surprise increase in exports from China. Third, they've done a big public infrastructure investment push that has also accelerated the recovery. But now you're seeing, we were concerned that the recovery was unbalanced and it was mostly being driven by public demand and not by private sector demand. But in recent months, we are seeing strong recoveries in private investment, strong recoveries even in private consumption. All of these factors are leading to a very quick recovery in China.
Is that likely to have favorable spillover elsewhere, or are we seeing? Is there a likelihood of a pickup in net imports coming from China?
Yes, as China does well. Firstly, it has spillovers to its neighbors. That's where it has a lot of its trade with, and it's the imports it purchases from its neighbors, and so that has positive spillovers to countries in East Asia, in that region. In terms of the effect on imports, yes, as its demand goes up, you can see that it should be buying more of everything, including things from the rest of the world. China has also before this crisis was rebalancing its growth towards being more domestic demand driven as opposed to export driven, and I believe they're going to continue to make that transition. So that also should help with helping the global recovery. But again, if you look at what are the main factors that are keeping the global recovery weak, I would say, the main thing is in dealing with this pandemic. And the sooner one can bring an end to it, the better. And that would have the most strongest effect, of course.
So last question. There are many students and alumni in the audience. They're thinking about their careers, potentially in business, academia, and the public sector. Do you have any suggestions for people who are starting out in their careers?
Firstly, I wish you the very best with your careers. These are difficult times. I'm not going to deny that. Coming out in the job market, looking for jobs in an environment like this is not great. But I just want you to stay hopeful, because next year, if things go well and if there is going to be the kinds of developments we expect on the medical front, then you should start seeing recoveries everywhere in the world. And so with that, prospects will improve. So, don't be disheartened by it. In terms of where to, kind of what areas, I hate giving that kind of advice because, I think everything is ultimately a personal preference, and you can decide for yourself what you should be doing. But use any opportunity that comes your way at this point. If you can't, if you can do something online, if you can take a course online, do it. Make the best of what you can do.
So thank you very much for this excellent chat. We expect to post the video of today's program on the website of the Center for Global Economy and Business reasonably soon. And for the audience, this is the final center event in the fall semester. We look forward to seeing you again for the Spring 2021 Economic Outlook Forum in February. Thank you, Dr. Gopinath, and thank you all for joining us today.
Thank you.